following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome to the Option Block. With you as always, I am your host, Mark S. Longo. Oh wait, no, I'm not Mark Longo. You can probably tell because I'm not wearing a goatee right now. It has nothing to do with the fact that my voice is 9 pitches higher than his either. But welcome to the Option Block. I am Mark Sebastian, and with me are my wonderful co-hosts, Alex Jacobson from Options Express.
Hey, Mark.
Yeah.
Mike.
All right. And my favorite former Buffalo Bill, Mike Tusaw.
Well, it's good to know that I edged out Jim Kelly on that one.
You know, it was between you and Don Beebe, actually.
Oh, between me and Don Beebe, huh?
Yeah.
Don Beebe's a good guy. I like him.
Well, ever since he stripped Leon Lett, that was the big one.
Don Beebe's actually a good friend of mine. He's a great guy.
Now, he is a great guy. I've heard nothing but wonderful things actually about him.
He lives up to it. He's good people.
That's great. So, anything special going on in your guys' lives?
My son got sent home from school today with a stomach ache.
Oh, yeah.
Oh.
Well, Mike, you know what's not having a stomach ache?
What's not having a stomach ache?
The financial markets. And let's roll into the trading block.
The Trading Block.
And welcome to the Trading Block. This is where we're going to talk about what drove markets today. And, the S&Ps are right up against that all-time record high. They closed the day 1563.23, up $8.71. The Dow closed above 14,500 at 14,539.14, up just a touch under 84. And the NASDAQ, which continues to trail the Dow and the S&P in performance, rose 8 handles to 2807.30. The VIX cash was off 0.54%, down to 1129. And the bond market continues to kind of hold above 2%. Alex, what were you watching today in the markets?
So one real interesting story that crossed the tape today was the Citadel story about Citadel exiting the E-Trade position. But what's interesting is not so much that they exited the E-Trade position. The Journal reported that with the stock down 75% from where they bought it, they still turned an $800 million profit through hedging, overwriting, and trading around the position with options. So I know we're not all Citadel, and I know our listeners aren't all Citadel, But here's a case where they had a very concentrated position, almost 10% of the company, from the time they bought it till the time they sold it today. When they got out today, they drove the stock down around 6%, but they turned an $800 million profit with a position that's down 75%. So it shows you, if you can aggressively manage using options, that there's a lot you can do to salvage a position. The other big story up here today, and as I've mentioned before, I sit between the options desk and the futures desk, but the futures guys were just swamped today with trades in nat gas options. Nat gas had a big move today, adding about 13 cents in the front month. That's almost a 4% move, but it looks like the 360, 370, 380 strikes have gone in the money in the last couple of days. And what customers were doing for the longest time, because nat gas was pretty much in a trading range, looked like there was a lot of premium selling. And of course, today with the big move in the front month, you're going to have a lot of covering. But it looks like huge activity for nat gas in all the strikes from 360 to $4.
Yeah, no, wow, that's a nice move. Nat gas has had a pretty nice bounce off that Feb 15 low.
Yeah, I have been waiting on this for so long, and this is finally. I feel like I'm hunting big game, sitting out in the woods for days and days on end, and I'm finally seeing the big moose come around the tree.
Yeah, it looks like everyone's going to be following that, like looking at that 3.925 as whether it can break that high. It's that was its high from 2011, or its last. That was like a last peak in 2011 before the massive sell-off, and that was where it ran into some resistance back in November of 2012. So that appears to be the level they're watching. That's just, and that E-Trade story is incredible, and goes to show you the power of options trading around a position. I think that's a lesson that a lot of retailer traders could make from Citadel. Just, Citadel is this massive, I'm not going to say they're evil, but I've never said a lot of nice things about them. Let's just say that. But I think there's a great lesson retail traders could take about their own long-term positions that they hold in watching that E-Trade position. Don't you think, Mike?
Oh, absolutely. Those guys are my heroes. Now, Alex, to give our listeners kind of an idea of how big the position was, you said it was an $800 million profit. How big? 27
million shares, which is only about $300 million, although they had invested other monies. The Journal reported an $800 million profit in a stock that most, what I'll call traditional stock customers, would have viewed as living dead money. Mm-hmm. But because they were proactive, $800 million. I mean, that's
phenomenal.
Yeah, it's a testament to what you can do, and a testament to, if you understand options, there is no living dead money.
Yeah, it's like watching Citadel is like, I can now imagine what it was like to be an opposing opponent watching Michael Jordan play. You're up against him, you hate him, but they're so good, you're just like, you have to stop and stare and look at them in awe. It's incredible.
You got to respect the talent, and you've got to respect how ambitious they clearly were here, and the fact that the Journal picked up the story. I mean, you got a stock that's down 75%. Most of us would be lamenting, what you could do with a position like that, and they turned it into a win-win.
That's amazing. Yeah. You're right. It shows the power of what options can actually do. And the other thing, Citadel, I'm sure they have at least one loss on their books, but it's one of the ones to where they're that talented to where they can make a losing position that profitable, especially one that's that much of a loss. It's amazing.
Absolutely. Mike, I'm looking at the overall markets, and here we have the VIX closing at a new low relative to 2007. We're going to keep bringing up these lows till we actually break it. And you got the S&Ps right up against their all-time high. You got the Dow well through it, and the NASDAQ more than $2,000 away. I think it shows you where leadership has been in this market. And, well, a couple of things. It shows you what kind of asset bubble the NASDAQ was, and then it also shows where leadership is in the equity markets.
Oh, no doubt about it. I mean, like today, obviously financials have been a big part of the rally in general. Today, energy was a big part of it. Thank you, natural gas. But for sure, technology has definitely been lagging it. The fruit company that I'm sure that it's in our quota, we have to talk about at least once today. That's definitely, I think, played a big factor in the NASDAQ trailing behind. But when you think about as much of a run as Apple had on the way up to 700, it didn't take the NASDAQ with it as much. But now it's kind of interesting. It's almost as if the NASDAQ is kind of catching up to Apple, and Apple is slowing down to get back to the NASDAQ right now.
Right. I had one of my traders say, Google and Apple are conspiring to make the NASDAQ go nowhere.
They're doing their best, that's for sure.
They really are. But, man, I'll tell you, that VIX is, the funny thing is that, people are looking at this VIX and saying, I can't believe it's trading 1130. But then if you pull up a chart of realized volatility, if we go to like volex.us and look at where realized volatility closed over the last 21 days, it's at 1111, and 10-day vol is right around 5%. So despite the fact it's trading 11.3 and that's low, the long term, relative to how much we're actually moving, it's expensive. And if you look at kind of the spread between VIX and VXV, that's the 90-day, that's a nice steep yield curve, and there's a heavy contango curve in the VIX futures that point toward this market, despite the low vol, not being complacent. One of the things, Alex, I would love for you to, I think that you would be probably the best to expound on that. Can you maybe take 2 minutes and explain to our listeners the difference between low vol complacent and low vol?
2 minutes.
Low vol
complacent. Okay, so quick answer is I bring a different perspective to vol. I look at vol as the cost of hedging. And to your point, the low vol complacent, in terms of people laying off risk or managing risk in this environment, it's been a very orderly move. Without getting overly academic, if you looked at Black & Scholes, they talk a lot about vol as the cost of delta hedging. And that's not been an issue here. I mean, it's just real easy to get stuff done. There's good liquidity. There's good transparency. If the market moves 0.5% a day, that's a realized vol of 8%. For those listeners who don't understand the calculation, the annualized number is just 16 times the daily number. So if implied vol is 16, that's forecasting a typical daily move of about 1%. We've had a typical daily move of today about 0.6%. So, that's a realized vol in the 8-9 area. But the one thing I will say again is, at least in my lifetime, every vol low in hindsight has preceded a large event in the market. And sometimes it's been up and sometimes it's been down. So I'm not sure if that's what you were looking for, Mark.
No, I think that's a perfect explanation.
Yeah, vol's real interesting because this whole community has sprung up of trading listed vol, trading the exchange products, and it's become quite an industry unto itself. Keep in mind that industry was always there. It was less transparent. It was upstairs, and people always looked at it. But now it's in the day-to-day language. I mean, you don't listen to a business report or turn on the TV without them quoting VIX as the fear gauge. But vol is two-sided. It's fear and opportunity, and I think what you have here is a market right now that's reasonably easy to hedge, not a lot of concern. The Bernanke put No real alternatives in interest rates. Interest rates, if you look at the 10 years, actually crept up a little bit, and I think that's a healthy sign. I know a lot of people say that when interest rates go up, it creates competition for stocks. We talked about this a few shows ago, that I think we all would have been more concerned if the 10-year had gone into the 140, 150 area, and that would have indicated an economy that was just puking and not going anywhere. The news is all pretty good.
Absolutely. So, no, Alex, that was kind of what I was looking for, and appreciate that. And we would be remiss to finish up the trading block without talking about the mini options that are going to list on Monday the 18th. Alex, what are your thoughts on these new mini options that are listing?
We kind of have a bet going on the desk here of what we think minis will do in their first week. Minis start trading on Monday on most exchanges, on Thursday on the balance of them. So we kind of have a bet going here on how much traction they'll get in the early days, and clearly a mixed view, but we are obviously excited about the opportunity.
Yeah, I think it's really exciting. Now, Alex, is there going to be any, people are going to want to know how Options Express and Charles Schwab is going to treat the minis in terms of, can you answer anything in terms of kind of margining, commissioning, things like that people might be interested?
Two different ways. At Options Express, when you go into the quote chain, you'll have a drop down that will show minis. They'll be treated conventionally for now. You could do buy rates and things of that nature. They initially won't work in some of our tools in terms of things like probability and volatility studies, but the volatility and probabilities will be the same for the regular size options. At Schwab, it'll be very similar. Minis are going to be marked here at Options Express with the number 7 after the quote symbol. So the apples will be AAPL7. At Schwab, they'll be AAPL mini. But for conventional strategies, outright buys, buy rights, the cool thing now is obviously you'll be able to buy right on an odd lot. I think I mentioned on one of the shows, I own 150 shares of Apple, and now instead of just writing one call, I can write 15 of the minis. You notice the exchanges are fighting a price war over this. Some will not be charging to trade them. Some will be rebating to trade them. Initially, the transaction costs will be the same, but we'll evaluate that as time goes on, and we'll see how they trade. I'd be curious to hear what you guys think their first couple weeks will look like.
Yeah, now here's a question, Alex. So could I do a package of trades where I'm doing, how would Options Express treat how would Options Express on your 150 shares, would you do one big one and 5 minis? Could you do that as one order? How will Options Express treat that whole relationship?
A great question.
So right now that would be 2 separate transactions, and you'd hit minimum commissions if you did the 1 and 5. I'd have to do a run of what the commissions would look like, but I actually suspect it's going to be cheaper to do the 15 than do the 1 and 5.
Really?
Yeah. And
wow.
Because you'll hit the minimum on the 1.
Gotcha.
The other thing about doing the minis is you'll have the ability to trade around them. Strategy Mike talked about earlier is kind of peeling some stuff off and moving it up, or
you could scalp gamma on a 1-lot straddle using minis.
The interesting, I had a client today. I had an email from an old institutional buddy of mine, and who does convert arb. Now it's not a strategy we do here at OX, although if a customer wanted to do it. But his question, and he kind of got an unclear answer from his institutional broker about how minis would be treated from a convert arb standpoint, because you end up owning $60,000 of converts, and it's convertible into 580 shares. He could now do 58 instead of his doing 5 or 6 to hedge. So I think it's an interesting opportunity. It's kind of an academic argument in retail. Of course, every time I say that, Kenny Griffith, the guy who started Citadel, began his career trading doing ConvertR out of his dorm room. So there'll be a lot of interesting things you can do. I think what we're all waiting to see is what liquidity is going to be like in them.
You got to think it's going to be good. I mean, there's a reason why they picked these 5 stocks.
Yeah, and the options market in the first week of products generally has decent liquidity. If you remember the penny pilot, the first week or two was fabulous, but we'll see how it plays out long term. We're excited about it here because it's a whole new avenue, and gives you stuff you can trade around. I can sell 15 on my 150 of Apple, and I could roll 5 up. So it'll be interesting. Crossing my fingers, I hope this gets traction.
I like it too because I have a lot of exposure with GLD, and that's going to be one of the pilot products too. And I'm not going to do anything for a few weeks. I want to kind of get the feel for it. But there's a lot of clients that I have either over or under allocated, not by a lot, but just by a little bit. And if we can have these minis, I'd love to have, like in the same situation, 50 shares of GLD or 120 shares of GLD. Same concept all the way. Yeah,
I actually wrote up a 5-page or a 5-part series on how retail investors can use these. I went over covered calls, the wheel, and because this opens up, and believe it or not, Jim Cramer interviewed our good friend Russell Rhodes on TheStreet.com today, talking about these mini options. One of the major problems with options is that for the smaller investor is that up until these mini options, if you want to do covered right strategies, you couldn't do it on good stocks because they were all too expensive if you didn't have an account with $100,000 on it. Now, a guy with $20,000 can buy 10 or 20 shares of Apple, 10 or 20 shares of Amazon, spiders, and gold, and run covered right strategies on them the same way someone with a couple $100,000 could do, up until currently. And I think that's an amazing thing for the new investor and for the small time investor.
Yeah, and you know what? That's going to be our challenge because we've done a real good job, we the industry, discussing minis in our existing distribution network. That's kind of the conversation we had up here. How are we going to get to that odd lot customer who's really never been an option customer before? And to your point, Mark, they're kind of option wannabes, but how do we communicate that to them? An option-centric firm here at OX, pretty much, everybody's got option DNA. Every account's got option DNA. What will be interesting will be to see how they're embraced by the clients at Schwab, where the DNA is both, I'll simplify it and say there's a lot of stock DNA that isn't option DNA. There's a lot of option DNA. I think we did a good job of talking to the option customer, and I think they get it and they understand it. I also think the option customer has sort of a clientele issue here. They've positioned themselves traditionally around the 100 multiplier, and that's where they live. What we've got to get to make this work is that either odd lot increment or that odd lot customer. As the words are coming out of my mouth, I realize the term doesn't even sound good. Referring to them as an odd lot customer. But to Mike's point, there are people who own 50 shares of GLD. There's people who own 40 shares of Amazon. These are really high price stocks.
Yeah.
I hope they get traction. I think we're all going to watch it very closely on Monday, and markets will be good on Monday, and hopefully we get some genuine volume. But it'd be interesting to see 1 or 2 weeks down the road if it gets traction. We're also getting a maxi if the SEC approves that. Box filed for the maxi spider, which the industry has been kicking around for a while. So there's a lot of interesting stuff, going on. So next week should be fun. Should be interesting.
Yeah, I would love to get 100 retail investors in a room that have $15,000, $20,000 in their account, and work with them on how the quote unquote wheel of fun, showing them how a combination of cash secured put, long stock, and short call can work together to really produce a great stream of income and take part in market gains as well. I think that would be a phenomenal thing. So we're looking forward to that. With that, let's roll out of the trading block and we'll roll right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and with the Odd Block, first one is E-Trade Financial Corp. Alex, it wasn't just Citadel that appeared to bail on E-Trade Financial today. A customer was carrying the January 2015 10-17 call spread. They were long 30,000 of them. This looks kind of like the trade that our friend that was in Blackstone might have done. And today the customer said, you know what? When I'm wrong, I'm wrong, and pulled out of the whole trade. They sold 30,000 of the 10 calls, collecting $2.43. They bought back the Jan 2015 17 calls, paying 50 cents, collecting a net credit of $1.93 on the call spread. And, I think it just shows that that's now two pieces of clearly smart money that are saying kind of the online space vis-a-vis E-Trade is done. So you have to wonder whether that is bad news for somebody like TD Ameritrade that has also had a really great run, or one of the other specifically online brokers. TD Ameritrade is the first one that comes to mind that I think is most comparable to an E-Trade, and they gave away 1%, 1.5% today, along with E-Trade. But you just have to wonder. You see two big traders get out. Why would you get into E-Trade here? Next one is KRE. Now KRE is the KBW Regional Banking ETF. It's all the mid-tier banks, if you will. It's got your Fifth Thirds, your Susquehanna Bank shares, your Webster Financial Corp, yada, yada, yada. Today, a customer comes in and buys 11,500 and change of the January 2014 29 puts, paying $1.42. Now, since the customer was buying and it appeared to go up in blocks, my guess is that this was not a big bearish play, but was likely a customer coming in on as a prospective hedging trade. Likely, if you look at where KRE is, since the late September low in 2011, this ETF has doubled in price. It's gone from about $18 up to about 32. So call it 90%. That's an incredible move. This guy, I'm guessing, thinks that move is going to continue, but probably is in at a low price and wanted to hedge off at that 29 level if for some reason the KRE took a dive. Mike, you look at these mid-cap banks at all?
Yeah, I've actually been in. I'm not in KRE right now, but I've traded KRE in the past. I like the product for a financial play, and I think I like the ETF a lot actually. Now I don't know if I would want to get in it now based on price, but in general, I like the product a lot. With this one, the other thing that you made, did you see any other puts with that type of volume that maybe it was a roll up from a married put position?
No, that was the whole thing. It was just one huge trade on the January 2014s. It was definitely an open. The open interest on that line is 143 contracts, and the guy bought 11,000. Yeah.
Yeah, that's definitely, I would doubt that's a bearish play myself. Yeah, the thing that I like to do is stocks are going up, or when things are going my way like that, I think now is a great opportunity to do a protective put if you're on a stock that's had a great run. Stock's gone up, and you have the ability to continue to go higher with it, and it's a way with which you can be greedy and get away with it. This is a way that I like this play if that's what the trader is doing, because it's the prudent way to be greedy, in my opinion.
Yeah, and this way he gets to keep the dividend. And vol is at, I'm looking at long-term IV in this thing, and it is at the lowest level by far in the last 2 years. So, this guy's looking and saying, this guy or gal is looking and saying, you know what? I've done really well on my stock. I can hedge this thing. As Alex says, the cost of insurance, the cost of a hedge is incredibly cheap. Why wouldn't I lock in my gains a year out for less than 15% of the value of the stock, or less than 5% of the value of the stock? He pays $1.43 for that thing. That gets him out at 27.5. What is his cost of that hedge is super cheap. I mean, it's a little over 5% on his net selling price.
Now, I have another theory of what this could be too. Let's say, and I'm not familiar with any mid-cap bank company stock option policies, but let's say that you're an owner, you're a bigwig at one of these mid-cap banks, and you know that you have a bunch of stock options coming. You just got awarded a bunch of stock options at the 33 level or whatever the case may be, or you got awarded some company shares, and in order to not be taxed on them, you have to hold them a year. You'll be taxed on them, obviously, but to get a better tax rate, you'll have to hold them for a longer period of time.
Yeah.
Perhaps he's not allowed to buy put options on the specific company itself, and perhaps he's just looked to see the correlation between his company and this ETF, and that could be another way with which he's trying to hedge it in one way, shape, or form. Now, it would have to be quite a big amount, obviously, but
we're talking about a pretty big deal if that's what that guy was doing. But it's entirely plausible. Oh no, I got a Mark and Mark special here for you guys. This is in HEK Heckmann Corporation.
What the heck?
Hey-o. So the stock is trading $4.32. Somebody felt compelled to buy the September $3 puts for 25 cents 23,000 times.
Whoa.
Against open interest of 390. Looks like it was a price variation, so there might have been some stock tie there, but just an incredible purchase. The stocks had certainly had a decent run of it over the last 3 months. It got as low as $3.11 in November, and has since rallied all the way back to $4.32. That is a massive 40% move higher, although it's $1.20, 30% move higher. Or no, it's a 40% move. But it's just one of those where you wonder why. Why are you paying? This guy gets out at $2.75. I don't know. I don't get it. You big into the Heckmann Corporation?
I said the hex with them.
Well, they got some. Well, maybe these are they're water solutions for shale and gas exploration. So maybe it's maybe it's an environmental. They're hedging against Al Gore.
There you go.
Those are all my odd blocks. And with that, let's roll out of the odd block and into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome to the Xpress Block. This is the section of the show where I rest my vocal cords, a rarity, for my good friend Alex, and he's going to tell us some cool things going on at Options Express and that he's seeing on the desk.
So thanks, Mark. A little bit about what was going on today. One of the names I heard a lot across the desk from the options desk was Blackberry, which has clearly gotten into the news again, and a lot of interest in Blackberry. Again, as we talked about earlier with the Citadel ETF trade, I think Blackberry in a lot of portfolios was a living dead stock, and it's come to life again. So there's a lot of option strategies that you can employ. Ides Hub, we always like to talk about Ides Hub. Ides Hub today, the top return, market neutral strategy in the index is looking at the SPX PM going out to the Aprils and looking about $40 out of the money for put spreads, $40 out of the money for condors. In fact, all the index ideas, given the low volatility, is the April expiration. Even the weeklies aren't passing our filter of enough premium, but the returns coming out of the SPX, to see any real return, you got to go out to April. And, other than that, if you look at the markets overall, there's still relatively quiet markets. And that comes back to why vol is so modest. But that's what's been going on here.
And with that, we'll roll out of the Xpress Block and roll into the Strategy Block.
The Strategy Block.
And welcome to Strategy Block. This is the section of the show where Mike Tusa, the managing director of the St. Charles branch of RCM, comes in and tells us about what he's seeing and about some cool strategies.
All right. Well, thank you for that introduction, Mark. What I want to talk about today is just an adjustment that I made on my simulated index concept strategy. But before that, let me do a brief review of just the 10,000-foot view of what the concept actually is. Let's say that I have a client come to me and we have $200,000, and we determine that we want to have maybe half of that money into something more safe and then half of the money into some type of long-term market exposure. Well, what I like to do as a potential alternative to simply putting someone in a mutual fund or a basket of stocks is what I like to refer to as the simulated index concept. So let's say that we have the $100,000 of risk on capital, so to speak. One thing that I like to do is kind of a safety precaution is we'll take $80,000 of the $100,000 of risk capital and put it into something like a municipal bond, some type of tightly collared instrument, perhaps cash value investment grade life insurance, something along those lines. And then with the $10,000 to $20,000, we'll put them into a call. And the concept is to, if the market goes up rapidly or a lot, whatever the case may be, then you'll benefit from the call option. But if we have another 2008, then what's going to happen is most of your money is going to be in that safe instrument that hopefully is safe for you, whatever the case may be. A lot of times I like doing this for clients that maybe have a little bit of money in an IRA. We'll trade the options in the IRA. And then with the money outside the IRA, we'll create some type of a tax-deferred vehicle to maximize things for tax purposes. Now, the move that I did today in the simulated index concept, I'm doing a call spread right now on SPY. And the basic way with which I've been doing diagonal call spreads, and I've been doing this for I don't even know how many years. I've been doing it with my own portfolio, even years before I came to on the managed money side of it with other people's money. But what I like to do is go about 6 months out and sell an in the money to I like to buy an at the money to in the money, depending on market conditions, call option on SPY. And going into today, I was long the 145 call option for September on SPY. And what I've been doing with that for the past few months or so, I've been selling weeklies on it. I've been selling monthlies, just whatever the market has been able to give me, I've been able to take premium. And I've actually been able to dodge a few bullets and luck out a few times when the market's gone up, and that I've been doing weeklies and the market's expired just below the short strike. And I've had to roll up a few times, but for the most part, we've been doing okay on the sales side of it. The last 2 weeks, I've just been long the call option. And obviously that's benefited. It's one of the ones to where volatility was so low that it didn't make any sense to take on the risk of selling premium to try to find more premium and just create something out of nothing. So what I did today, as a way of trying to take advantage of lower implied volatility, I took a look at the 145 call option out in September and realized that we had approximately, and I don't have the numbers up in front of me right now, but we had probably about $3 worth of time decay in it. Maybe $3.50 of time decay in it. So with that, I'm looking at and thinking, okay, we have an option that's worth $13 approximately, and we have approximately $3 worth of time decay in it. When looking at something like this, we need to make the decision, does it make sense to have that much intrinsic value? And I don't believe it does, quite frankly, because of the fact that what I need to do, my job as a trader, is to make up the time decay. So what my job is as a money manager / trader, whatever you want to call me, is to finance that time decay. So I'm looking at, I think I feel pretty confident that I can get sell $3 worth of, as Andrew would put it, juice between now and September expiration, whether it's with weeklies, with monthlies, bi-monthlies, whatever the case may be. I'm pretty confident that that's something that I can do. But I'm looking at this, and so there's a couple of things that are going through my head right now. With volatility as low as it is, like what Alex says, not guaranteeing that we're going to get a big move, but there is reason to believe that we could be in for a big move at some point in time, whether up or down. And to also combine with that, there's really not a whole lot of premium to sell right now. So instead of selling another call option on the way up, I rolled the option higher. I did what perhaps that KRE trader did in a simulated manner or in a synthetic manner. Maybe he bought a put option to protect his profits. What I did is I sold the 145 calls for a profit today, and then I bought the 157 calls. Now, with that, I got an $8.30 credit. I took $8.30 of risk off the table. Now, granted, you might be saying, well, Mike, why on earth are you buying an out-of-the-money option and at this stage? Why would you do that? Why are you buying something out of the money? I know it's only out of the money by like 30 cents, but why would I do something out of the money? And the oversimplified answer, it was the cheapest. I was looking through the options earlier today, and I want to be around 6 months out. That was basically the best bang for the buck, so to speak, after analyzing all these different strike prices. Now, what my job is as a trader or as a money manager, my clients still have upside exposure to the market. However, there's not quite the same amount of deltas on the table. So what I need to do, what I'm committed to doing for my clients between now and the month of September, is selling $5 worth of premium instead of $3 worth of premium to make up for that time decay. Keep in mind, I still have a complete upside from 157 on up. I just paid $5 for that privilege. What I need to do is I'll use Citadel as my role models here. I need to find a way to get $5 between now and September. And if I can do that, then we have full upside on the marketplace as in comparison to what for the clients that have 80% of their money in the safe things. This is their little M80, so to speak. This is the catalyst for growth of the portfolios. And with this, now I'm at a point to where if the market does go down, let's say that we touch the highs of the S&P 500 and then the market just goes down the crapper tomorrow, so to speak, then we have a lot less risk on the table. So this is a way with which I like to manage risk, take advantage of what I believe are lower priced options, and still give the client and myself, because I do this with my own personal money too, and give myself the ability to have market exposure to the upside. And that is the strategy for today.
Oh, that was just beautiful. And with that, let's roll out of the strategy block and roll into around the block.
Around the block.
And welcome to Around the Block. Mike, what are you looking for toward next week?
I'm staring at that S&P 500. We're right at the all-time highs, and that's the main thing that I'm watching right now. I want to see how that reacts to it. Pretty much we were at some key levels from the standpoint of the Dow being at 14,000, the Russell 2000 being at 900. Obviously, we've blown through them. So the next barrier to the upside, in my opinion, is the S&P 500 and their all-time highs. Other things with which I'm looking at, gold and silver are boring the living bejeebers out of me right now. And it sure feels like to me whenever those get boring, it's kind of like watching the triple option in football. They'll bore you to death by run the dive, and then all of a sudden, once a quarter, they'll throw a 60-yard pass and then surprise. Mm-hmm. That reminds me a lot of the movement of gold and silver. So those are three things that I am staring at with both eyes.
Yeah, here's a question for you. When the S&P breaks its all-time high, what do technicians do to find resistance levels? Do they just pull things out of their hat?
I don't know. I think that's when, I don't know. They sell more stuff, I guess.
I guess they're going to say 1,600. You got to think, right? They're just going to look at even numbers. But yeah, Alex, are you watching anything?
Yeah, with vol this low, kind of back to Mike's strategy block, you got to own some premium. You just got to own some premium. If you're worried about the market, you're worried about your stock positions, put hedges are cheap. But to the point that Mike just made, one of the biggest opportunities is the ability to manage risk if you own cash. And having been on all three sides of this business, national wirehouse, electronic brokerage, and exchanges, one of the things that comes up all the time is you got a customer who's been sitting in cash. You know, they bailed at some point because they were afraid, and you kind of pose the question, what's the risk of cash? And everybody says, no, there's no risk. Money markets, T-bills. Yeah, there's a risk, and the risk is the melt up. And right now we seem to be going through this melt up, and I think you got to choose sides or choose both sides and do a strangle or a straddle. But I think you got to own some premium here. And I think with vol at these levels, 3 months, 6 months from now, to both you guys' points, we're not going to be sitting here. We're going to be at a number vastly different than we're at right now.
I couldn't agree more. Yeah, I'm with you both. I mean, the VIX is at 11.3. If you're afraid of this market, all right. If you look at this market and you get completely frightened, you can buy. I'm just pulling up SPX. I can buy December. I mean, I'll go back. I can buy December 2015 call options in SPX for around, call it a 16, 17 vol, which is still below VIX, to go out to June for 12 vol. April options, the regular April, according to Live Vol, closed below 10% vol, their average. That is just I mean, I can buy the at-the-money call option for about 1% of the value of the S&P 500. Think about that. We moved 8 points today, which is a little over 8.5 points today, a little over 0.6%. And I can buy a call option that will make its money in 2 days. It just seems like a no-brainer. Stop me if I'm missing something, Alex.
No, spot on.
Thank you. Well, there's a rarity. Wow. Now I'm like beaming now. And, in terms of things that I'm watching, the one thing that I think could really derail us is the Italians. We saw what happened when that election went haywire. Now, there's a lot of belief that Italy's going to get their act together and that they're not going to completely fall apart and that some accord will come. I think if it doesn't, that's where you could see some real problems. The other thing is I now think that we're in an economic environment where, 3 months ago, I think meeting expectations because of Fed intervention was seen as bullish. And so that's fine. Now we're in a situation where I think we have to start really doing well on some of these economic reports. Otherwise, you're not going to get, you're going to see the market kind of easing off or even selling off on some of that action. And with that, what's going on at Options Express in the next couple of weeks that you might want to bring everybody up to date on, Alex?
Okay, well, the crew is doing a live event in San Francisco at the Westin at the airport on March 23rd. And as with all our live events now, we simulcast that. We did an event in Lombard this weekend. Actually, I came out to that to spend a couple of minutes with folks who were coming because of the Insider podcast that we do every couple of days. Had a good turnout, and people are talking about exactly what we're all talking about now: low vol and some disbelief that vol could stay this low. And the discussion was what to do about it.
And thank you, Alex, for that. And Mike, what's going on at RCM?
The webinar train continues to roll this coming week. Thursday night, the 21st. We're going to have Kevin Davitt coming back on. He's going to do a webinar, and I love this title. It just shows the marketing genius of our firm, oil. That's the title. He's going to be talking about, you guessed it, oil, ways with which to trade it, how it works, some of his thoughts on it, and he'll be on the interview block this coming Monday on the option block as well, so make sure you tune in.
Awesome. And at Option Pit, it's officially on the website now. I've got 2 big events coming up in New York. On April 20th, Trading VIX with options, futures, and exchange-traded products. It's going to be me and Russell Rhodes with Jill Malandrino teaching, spending 8.5 hours going over VIX contracts and VIX derivatives and how to trade them. And then in June, I'm doing the Street Monster Conference. It'll be me, Jim Cramer, Stephanie, Jill again, and we're all going to it's going to be a 2-day event. You can go to optionpit.com/events to see everything that I am up to. And again, don't forget to read the blog. And with that, we will end the option block this week, and we'll see you next week. Have a great weekend, everybody.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.